Hello, welcome to Adam's Swing Trading Masterclass, Unit 2. We're going to be looking at market behavior today, Bitcoin and alts together. Disclaimer, any views or opinions in this course are strictly my own. I'm not a financial advisor, this is not financial advice. Tactics, strategies, philosophies, and fundamental principles here are mutually exclusive with material presented by the other professors. This is because my methods target different goals to theirs using different data. The learning objectives for today are going to be looking at Bitcoin. We're going to be doing a bit of a deeper dive now, looking into the nature of the beast. It's going to be a bit more complicated than Unit 1, but we'll take you through it step by step. Learning objective 2, Bitcoin signal. We're going to be extending some analysis from Unit 1 and looking at some deeper principles here, preparing you for further lectures where we go into a super deep dive onto all the different indicators and data sets I use. And number 3, the altcoin market cycle. First up, I'll have a look at Bitcoin. First of all, there's no conjecture on the subject of Bitcoin's volatility or extreme historical performance. Bitcoin is the yardstick that all cryptocurrency investment performance is measured against. Bitcoin's volatility is extreme. With timing, an investor could have caught 27,000, 6,000, 1,000, and 8,000% rallies for a cumulative 1,295,999% Yes, you read that correctly. I've done the maths myself. Avoiding the drawdowns and selling at the peaks would have grossed an investor over 1 billion% over the last 10 years. Of course, that would take a little bit of skill. The volatility of Bitcoins persistently exceeds that of any other major asset class. Gold, S&P 500, stocks, currencies, or anything. Even oil for the most part. Volatility is the lifeblood of opportunity. This is why Bitcoin acts as a giant magnet for the attention of enterprising individuals thirsty to exploit those opportunities. This is a good example of pretty much the highest performing asset, second asset over the over a time frame you're trying to force. This here is ticker code TQQQ, which is the triple leveraged Nasdaq. The Nasdaq stock market index over the last decade really has been the highest performing stock market index in the world, and this is the triple leverage version of it down here in the orange. You can see that it's only returned a measly 7,500% over the last few years, whereas even when we're fitting it to try and make the stock index as high performing as possible, Bitcoin still beats it with a 2,000,000% return. So obviously Bitcoin is the daddy of all returns. Even this one, for example, where we start at the very beginning of this data series, you can see that it opened with a drawdown to give everything else a head start, and yet we still beat all these other assets and individual stocks that have performed very well over the last several years as well. So what you're looking at here is what's called a distribution, or it's kind of like a histogram. It's a distribution of the price returns. These are the daily price changes. So this is a good way of understanding the market from a way that I view it. You can see that the normal distribution in green is actually what the price returns for an asset should look like. This is kind of prescriptive. Most assets don't behave like this, even stocks, for example. But you can see here that what actually happens with Bitcoin is that a lot of the time, not much happens, which is all of the return distributions are clustered around 0%, slightly above 0%. But then occasionally, very rarely, a lot of things happen. You've got massive price movements on single days, up or down, and you don't really have a whole bunch of the mid-range stuff. Either nothing really happens or massive moves happen. This is typical of stocks, actually. So this is called kurtosis, where you have an enormous discrepancy in the distribution. However, you can still see that if you were fitting the normal curve to this, you could modify it slightly to bring the edges in here. So just remember that it's the Bitcoin market is punctuated by enormous moves and then a whole lot of nothing. Right, so if we're actually taking the price returns and we start to look at it over longer periods of time, you can see here the daily returns. This is kind of like the previous slide. not a whole lot of anything happens. And then as we get to weeks, it starts to spread out a little further, and we have big weeks and small weeks. But as we get out into monthly returns, you can see something very weird starts to happen, and the distribution gets skewed right out to the right-hand side on the positive returns aspect of it. Now, this is an idealized version of that same curve. And when I think about the price behavior of Bitcoin, this is actually what I see in my mind. You can see here that, and please ignore the numbers. It's not accurate. I took this from somewhere else. You can see here that when we're investing in Bitcoin, what's actually happening is that the prices are constrained at a maximum loss. You can only lose everything that you have, but not more. But when you gain, you can potentially gain out to infinity. This is why sometimes Bitcoin is referred to as a call option, is because this payout distribution really gives you unlimited upside, but for a fixed downside potential. If we were actually drawing this with Bitcoin returns, this number 2 here would probably be a number 1 to represent 100% of your starting capital. And then you could go out to infinity, or you could go down to 0 capital, but you can double, triple, quadruple all the way out depending on how far you want to take it. So coming to terms with these behaviors is not quite complete until one fully considers the mathematical implications of Bitcoin's asymmetrical performance. Additionally, being a naturally unlevered asset, an investor can take on a fixed level of risk, maximum 100% loss, for hypothetically unlimited gains. Bitcoin is not a CFD. It's not an option, strictly speaking. There are no margin calls and there are no margin loans. It's just pure investment savagery. Now, let's have a brief look here at the quality of the returns. You can see here that if we're looking at high-performing stocks that you all know about, and stock market indexes and everything, this pink line represents equality between risk and return. This is the one-to-one line. So you can see here, if we're taking on 80% risk, we're going to be receiving 80% return, hypothetically, if our assets stuck along this line. What we actually want to see are assets that give us more returns than they do with risk. So you can see here that because Bitcoin is on the top of the line over here, it's actually, even though the risk is still quite high, we're receiving more returns than we are receiving in risk, which makes it an excellent asset. This displayed on a rolling basis over any 4-year period, you can see that there was actually no point in history where Bitcoin wasn't the superior risk-adjusted asset in the entire world, which is quite incredible, honestly. We have to have a quick look at drawdowns, though. Drawdown frequency is far more often than other assets, where every few years you can receive up to an 80% drawdown. You can see it's getting slightly less over time, but the average drawdown of about 50% can happen almost every year. So we need to be very careful with what we're doing, always thinking about what the worst case scenario is and positioning ourselves so that when we do receive giant drawdowns that we're ready to go. And this is pretty much what Daniel's dip buying bot is for. But within this within the context of swing trading, we're going to be looking at that as well. Okay, so let's look at expanding on the Bitcoin analysis from unit number 1, analysis philosophy. Quantitative versus qualitative. This one is very important to me. Quantitative essentially means numbers and numerical things that are factual data points. And qualitative is like stories, things that you're trying to derive from logic and reasoning and so on and so forth. You may notice when first learning how to invest that there is a lot of talk going on, ideas here and there, lots of opinions. Trying to derive a prediction using stories and the logic of other unsuccessful investors is no different to apes bashing rocks against other rocks. They think they're doing something, but no actual progress is being made. This is because stories come riddled with human cognitive biases and heuristics. The market deals in probabilities, not stories, in my opinion. In this respect, quantitative analysis is superior to qualitative analysis. Pulled this picture of the mind because ultimately, if you're not thinking in the forms of principles, maths, and tested processes, really you're just kind of making things up, I believe. you'll notice that from Unit 1, I took the slide from Unit 1, you'll notice that when I went through analysis methods and their reliability, there wasn't a single qualitative method of analysis in this list. They're all quantitative. Every single one of these relies on some sort of data set, rule-based system, or maths. Because basically, if what I'm trying to do is I'm trying to take everything I do, and you by extension, from a space of mostly made up stuff in faith, all the way up to empirical evidence. If you're smart, if you're a disciplined student, you'll recognize this diagram from a previous lecture, and you'll understand exactly where I'm coming from here. I won't harp on it too much because you've already seen this before, but this is critical because, like I said, this fits into my philosophy of trying to get rich for sure. We're trying to engineer and eliminate everything that can't be testable. Eliminate all this bullshit. We're trying to get rid of it. Okay, so let's get into some slightly more meatier stuff now. Some of you will recognize this again, but I just wanted to bring it up in the lecture so that you can hear me talking about it. There are 3 types of tactical principles when it comes to investing. Is it expensive or cheap? All right, this is the first one. This is the least difficult of the 3 different tactical principles of investing over a long period of time. So we're talking years here. It's hard because things that are very expensive can keep getting more expensive, and things that are cheap can keep getting cheaper. This is difficult due to noise and randomness, but it can be used in mean reversion strategies. You can see here, this particular one, beam indicator, very basic, is just to basically show how expensive and cheap works. You can see here that it would be useful for picking the top and bottom in this particular section of the market during this time. Wasn't useful recently, but this is a good indication of what I mean by expensive or cheap, overbought and oversold. And price trends. So is it trending up or down? This type of methodology is often wrong in ranging markets. You get whiplashed and you get tons and tons of false signals which eat away at your account. So it's wrong in ranging markets often, but it gives you exposure to large moves when they occur. It's harder than number 1, but it's still easier than number 3. In case you're curious about this one, this is nothing special. I cherry-picked this particular thing just to show the example of what a trend following strategy looks like. This one blew up the account over here and semi-blew up the account over here. Hypothetically, I didn't run this one, but yeah, just to give you an idea of what trend following is meant to achieve. It's kind of basically what my entire strategy is meant to look like in practice. But it's all easier than number 3, which is predicting the future. Where is it going to go to next and when? Impossible to answer, but easy to ask. Hence why it's the first question most novices ask. They don't understand that it can't be done. No one actually knows where anything is going in the future, but we have probabilistic methods of entering and exiting the market when there is a high probability of making money. Fucking don't ask me for my price targets. Right. That being said, experience does give insights. This is one of the moments where I was kind of brought out from the fray within the war room. I made a call that would basically picked the top in Ethereum within a few dollars and warned everybody about it. It wasn't a part of my actual strategy at the time, but yeah, there was a lot of guys that acted on this and took their profits pretty much at the exact top of the market, thanks to my call, which I was very happy to provide that service for them. It was slightly less accurate on Bitcoin, but it still worked out quite well. So yeah, you can call that predicting the future. You can call it whatever you want. Essentially, it was just the spider's web of data points in my mind, all kind of coming together at the same time with experience. You can develop this too over time, but it takes a good understanding of the fundamentals first before you get too advanced. Now, this is one of the sheets that I use to track a lot of my information. You can see over here that some of the websites that I use for some of my my data points, that's all open right there. You can just basically copy and paste that into your browser or like type it into your browser, do some searching yourself. What I'm going to be doing is I'm actually going to be going through every single one of these indicators and describing to you where it sits within my trading philosophy, the importance I place on them, how I use them, and how you can use them as well to make better decisions with your trading and essentially try and get to the point that I am at. Market correlation is another big one that I like, which it really doesn't have anything to do with overbought, oversold. It's kind of like in its own little realm, and it can get quite complex. I use this table here. I keep refreshing it all the time, trying to get the correlations from all the different asset classes: stocks, US dollar, gold, break-evens, bonds, and the VIX, and just essentially comparing that to all the different assets. This leads to a couple of important implications. Bitcoin is correlated to major stock market declines. So I'll just go back 1 second. Whoop. You can see here that it's slightly correlated to the stock market at the moment. It's doing quite well. Bonds will ignore that for the moment. So Bitcoin is correlated to major stock market declines. Sometimes it's not really correlated to smaller declines, which is weird. It's only when the stock market starts to accelerate to a certain point where it's like a catastrophe that Bitcoin goes along for the ride. Therefore, watching for recessions and transient volatility in stocks can be of importance. So I cover this type of stuff when it comes to stocks in the stocks channel. I'm not super active in there at the moment, but there can be information that I'll be sharing in there on this. Some short-term moves in the US dollar can affect Bitcoin because, after all, Bitcoin is denominated in US dollar. If the US dollar becomes stronger, that's going to affect the ratio and actually bring down Bitcoin. So yeah, that can affect risk assets as well, and everything kind of feeds into itself. So that can be important to watch sometimes. Methods of detecting probabilistic price ranges in traditional assets. To fully exploit correlations can be found at my fractal range or purchased from Hedgeye, which is what I use, to help you determine the likelihood of future moves. Correlation trading is not essential to swing trading, but it does help a lot, and it also gets you into that mindset of being able to kind of like I wouldn't say see the future, but like really get an understanding of like the behavior of the market, really the sentiment of the market, like through pure price. So you need to rely on external data sets less.